In a previous video, we talked about the differences between a free market economy and a command economy. And focusing specifically on a free market economy, one of the questions that we have regularly is, well, how do we determine prices? If we as a market, which is a collection of consumers, determine what gets produced and how and who acquires access to those resources, then how do we set price? If government isn't involved in that process, then how do we determine what items on a store shelf would go for and ultimately what we would pay? So that really hinges upon this concept of supply and demand and establishing what we call an equilibrium price. And we're going to go into that in a little bit of detail. So what I have here is a graph that shows on one axis the price ranging from $5 to $20. And on the other axis, the quantity, which would be the units that are sold or produced. And that ranges from 5 to 20 units as well. So there's a couple of things that we need to factor into ultimately how we set price. So the first thing is what we call a supply curve. And it looks something like this. It is upward sloping, and that is meant to resemble that as the price of a good continues to increase, producers or businesses are willing to produce more of them. And this is fairly intuitive, right? If you are a business owner and you realize that there's a market where people would pay more for a particular good or service, then it's in your best interest to try and produce more of them since you're going to be earning higher profit margins. Now, on the other end, though, we also have to take into account what people are willing to pay. And that's where we get this downward sloping curve. That's what we call a demand curve. And so consumers, as prices decrease for a good, so we can acquire them for a lower cost, then we're of course going to buy more of them, which is why businesses slash prices when inventory is getting a little bit older or where they're trying to move product and discounts and different promotional offerings are done, because businesses know that if we cut the cost of something, people will demand more of them or demand will increase. So this interaction that takes place between supply and demand is where we get what we call an equilibrium price. And it's at this midpoint between where the supply curve and the demand curve intersect. And this is a very elementary example, but it's meant to show really at what price will people pay. So at what point will the supply, so what producers are willing to produce or create, equal demand. And so this is the point to where ultimately demand equals supply. So consumers are willing to acquire the adequate number of goods at a certain price point, and then producers are willing to provide that same number of goods. And this is really kind of a sweet spot here, because what happens is we don't have one of two things. We don't have excess inventory, and then we also don't have stockouts. And although this is a very simple example and it makes sense, this is very hard to do. And what you see in markets is retailers and different businesses are regularly experimenting with price to see what its corresponding impact is on the demand for a good. And obviously, certain goods tend to be produce consumers that are more price sensitive, which means they respond greater when there are fluctuation in price. And there are other types of goods where people are relatively price insensitive, which means if prices go up, they still consume a similar amount. So cigarettes are an example of something where consumers are relatively price insensitive compared to most products.